$10,000. That is the number on the headline. The new car loan interest deduction, signed into law July 4, 2025. Part of the One Big Beautiful Bill, the number was everywhere. Every personal finance site, every dealership email, $10,000. It is a good number, clean, specific. And it is almost certainly not your number. I did not come to that conclusion quickly. It took a while. It took reading the IRS fact sheet, then the proposed regulations published in the Federal Register in January. Then the Thomson Reuters breakdown, then the Bipartisan Policy Center analysis. Then going back to the IRS fact sheet again, because something was not adding up. The number kept changing, not the headline number. The headline stayed the same, $10,000. The number that changed was the one underneath it, the one in the fine print, the one that actually applies to you. That is what this is about, not the headline. The space between the headline and the footnote. There is a stillness to tax documents. They do not raise their voice. They do not warn you. They just sit there, page after page. And somewhere around paragraph 4 or 5, they redefine a word you thought you understood. The word in this case is qualified. Qualified passenger vehicle loan interest. That is the official term per IRS fact sheet, FES negative 2025 negative 03, updated July 25, 2025. And the way they define qualified is where the door starts closing. Because this deduction is a door, a wide door from the outside, $10,000 wide. But every condition they attach makes it narrower. And by the time you walk through every condition, you might not fit. The first condition, the vehicle has to be new, not used, not pre-owned, not certified pre-owned. New, original use begins with you. In 2024, roughly 15.9 million new vehicles were sold in the United States. Per Bureau of Transportation Statistics data, that sounds like a lot of people. But total new and used vehicle transactions that year were in the range of 36 to 40 million. Depending on how you count, so already more than half the people who bought a car are out. The door just got narrower. Second condition, final assembly in the United States, not designed in the United States, not headquartered in the United States, assembled. The physical act of the last bolt going in has to happen on American soil. You can check by entering the VIN into the NHTSA decoder at vpsa.gov. The Bipartisan Policy Center looked at the 25 most popular new cars sold in 2024. Those 25 models represent about 60% of all new car sales. Of those roughly 7 million units, approximately 4 million had final assembly in the United States. The door got narrower again. Third, no leases. The deduction applies to loan interest. If you leased your car, you are out. The loan has to be originated after December 31, 2024, and secured by a first lien on the vehicle. Fourth, personal use. More than 50% of the vehicle's use has to be personal, not commercial, not fleet. A kitchen light in a suburb somewhere, a browser tab open to a dealership website. Someone just read the headline, $10,000. They are doing the math in their head already. The monthly payment against the deduction. They feel a little lighter. They have not read page 14 yet. The numbers are public. The math is verifiable. What anyone does with it is theirs, but the math is where this starts to matter. Because the next condition is the one that changes everything. The income Phaseout. This is where the door does not just narrow, it starts sliding shut. If you are a single filer, the deduction begins to phase out. When your modified adjusted gross income exceeds $100,000. For every $1,000 over that threshold, the maximum deduction is reduced by $200. At $150,000, the deduction is zero. That is per IRS fact sheet, FS negative 2025 negative 03, confirmed by Thomson Reuters and TurboTax. For joint filers, the Phaseout begins at $200,000. gone at $250,000. Now, here is what that means in practice. Consider someone in the suburbs, Naperville, maybe. 38 years old, middle management, pulls in $115,000 a year. They bought a new Chevrolet Equinox off the lot in Joliet, assembled in the U.S., financed with a 60-month loan. This person read the headline. They expected $10,000. Their magi is $15,000 over the Phaseout threshold. 15,000 divided by 1,000 is 15. 15 times 200 is 3,000. Their maximum deduction just dropped from 10,000 to 7,000. That is not the end. That is the ceiling. The actual deduction depends on how much interest they actually paid. The average new car in the United States now sells for approximately $49,353 per Kelley Blue Book and Cox Automotive, February 2026. The average new car loan interest rate as of March 2026 is around 7% per Edmunds. According to Cox Automotive data, cited by Politico, the average new car buyer pays roughly $3,800 in first-year interest. $3,800, not $10,000. The person in Naperville, their cap is $7,000. Their actual first-year interest is in that same range. So their deduction is capped at what they actually paid. At the 22% marginal tax bracket, a $3,800 deduction saves them roughly $836. In federal income tax, $836. That is the real number, not 10,000, not 7,000, not 3,800, 836. Ivan Drury, a director at Edmunds, put it plainly in an April 2026 Politico report. It erases part of a car payment for 1 month out of 60. The fluorescent lights in the office are the kind that hum, not loud, just enough that you stop noticing and then notice again. The person in Naperville is sitting at a desk. They pulled up TurboTax. They are looking at the Schedule 1, a Part IV, no tax on car loan interest. They entered the VIN. They entered the interest amount. The number on the screen is not the number from the headline. Now, look at who this was designed for. The Phaseout starts at $100,000 for single filers. The U.S. real median household income in 2024 was $83,730 per the Census Bureau and the Federal Reserve Bank of St. Louis. That is household income, not individual. For a single earner making the median, the Phaseout does not apply. The full $10,000 cap is available, but median earners are not buying new cars at $49,000. Households with income under $50,000 have significantly lower expenditures on new vehicles. According to the Bipartisan Policy Center, they buy used. Used vehicles do not qualify. The people who do buy new tend to have higher incomes. The people with higher incomes hit the Phaseout. The door is wide for people who do not walk through it and narrow for people who do. The Bipartisan Policy Center estimated that savings from this deduction could range from as low as $300 up to about $1,000 for higher-earning consumers. Meanwhile, the same law, the One Big Beautiful Bill, eliminated the $7,500 electric vehicle tax credit, according to Edmunds data. Cited by Politico, that was a credit, not a deduction. A credit reduces tax liability dollar for dollar. A deduction reduces taxable income. A $7,500 credit is worth $7,500. A $3,800 deduction at 22% is worth $836. They replaced a $7,500 credit with an $836 tax savings. That is not a rounding error. That is a different conversation. The Treasury Department estimated that approximately 6 million loans were issued annually on new vehicles with final assembly in the United States per the Bipartisan Policy Center. As of April 10, 2026, Around 1.2 million tax returns had claimed the auto loan interest deduction. 1.2 million. For context, the overtime deduction has been claimed on 23.4 million returns, the senior deduction on 19.6 million, the tips deduction on 5.6 million. Those figures are from the Treasury Department as reported by Politico in April 2026. The car loan interest deduction, 1.2 million, dead last among the 4 new deductions. The Joint Committee on Taxation projected this provision would cost $2 billion in 2025, $5.4 billion in 2026, and $10 billion by 2028 per Politico. The Congressional Budget Office estimated making it permanent would bring the 10-year cost to $97 billion per the Bipartisan Policy Center. $97 billion. For a deduction that saves the average claimant somewhere between $300 and $1,000 a year. And then there are the tariffs. U.S. automakers depend on supply chains running through Mexico and Canada. Tariffs on steel and aluminum raise assembly costs. Those costs get passed through to the sticker price. The average transaction price already hit $49,353. In February, per Kelley Blue Book, the deduction is supposed to make cars more affordable. The tariffs make them more expensive. The net effect for many buyers is a wash, or worse. The person in Naperville closed the browser tab. The Equinox is in the driveway. The loan runs for 53 more months. The deduction saved them $836 this year. The car cost $47,000. The total interest over 60 months at their rate will be roughly $9,000. The deduction over those 60 months, assuming their income stays flat and they keep filing, might save them around $3,000 total. $3,000 over 5 years on a $47,000 purchase. That is about 6% of the purchase price, recovered over 5 tax returns. The door was $10,000 wide in the headline. By the time they walked through the conditions, new vehicle, assembled here. Not a lease, income under the Phaseout, actual interest paid. The opening was $836. The headline is still $10,000. The number is still 836. 836.